Most crypto investors think they only owe taxes when they cash out to dollars. That's completely wrong. The IRS considers dozens of crypto activities taxable events, including swapping coins, earning staking rewards, and even using crypto to buy things. And if you're not reporting these, you're accidentally breaking the law. Here's the reality. The most common problem I see is investors who thought they were fine because they never cashed out, only to discover they owed six figures in taxes from transactions they didn't even know were taxable. I'm going to walk you through every step of crypto transactions that trigger taxes, how to calculate what you owe, and how to stay compliant. I'm John Conrad from Numeratus. We're a white glove accounting firm specializing in crypto tax compliance. Everything you can imagine a big firm doesn't want to touch. Complex crypto portfolios, DeFi transaction, unreported gains from previous years, that's what we do. I've personally reviewed over 300 crypto tax situations and helped investors who got IRS notices for unreported crypto income. I've seen every type of crypto transaction you can imagine, which means I know exactly what triggers taxes and what doesn't. That brings us to point number one, selling crypto to fiat. The obvious one, with a twist. Let's start with the one everyone knows, selling crypto for dollars. You bought Bitcoin at $30,000. You sold it at $60,000. You made $30,000 in profit. That is a capital gain, and yes, it's taxable. But here's what most people don't understand. The holding period matters massively. Held for more than 1 year is what we consider long-term capital gains, taxed at 0%, 15%, or 20% depending on your income level. Held for 1 year or less is what we call short-term capital gains. It's taxed as ordinary income at your regular tax rate, and it's up to 37%. Many investors pay 37% on gains that could have been taxed at 15% if they just held for one more month. That's a 22% difference on a $100,000 gain. That's $22,000 in unnecessary taxation. So yes, selling crypto for fiat is taxable. Everyone knows that, but the timing can literally double your tax bill. Point number two, crypto to crypto swaps. The surprise that catches everyone. Despite what you might think, swapping one cryptocurrency for another is a taxable event. This is where 90% of people get into trouble. You bought Ethereum at $2,000. It goes up to $4,000. You swap it for Solana. You didn't cash out to dollars. You still have crypto, but in the eyes of the IRS, you sold Ethereum at $4,000, realizing a $2,000 gain, and you used the proceeds to buy Solana. That $2,000 gain is a taxable event, even though you never touched fiat currency. For example, an investor could start with $10,000 in Bitcoin. Over 3 years, they make hundreds of trades. Bitcoin to Ethereum, Ethereum to Cardano, Cardano to Polkadot, back to Bitcoin, then to altcoins. They never cashed out to dollars. Their portfolio was worth $100,000. And they think they owe no taxes because they never sold. But they owe taxes on every single swap. Their total taxable gains could be $90,000 and their tax bill over $30,000. And here's the worst part. They don't have $30,000 in cash because all the money is in crypto. They have to sell crypto to pay their tax bill, which creates another taxable event. This is the trap that catches most crypto traders. And that brings us to point number three. Staking rewards and yield, taxed twice. Earning crypto through staking, yield farming, or lending is taxable as ordinary income when you receive it. Here's how it works. You stake Ethereum and earn 5%. Every time you receive staking rewards, that's taxable income based on the fair market value when you received it. If you received 1 ETH as a staking reward when ETH was worth $3,000, you have $3,000 of ordinary income. You'll pay income tax on that $3,000 at your regular tax rate, potentially as high as 37%. Then, when you potentially sell that ETH, you have a second taxable event. If you sell it for $4,000, you have a $1,000 capital gain. Remember, $4,000 sales price minus $3,000 cost basis. So you're taxed twice. Once when you receive the reward as ordinary income, and again when you sell it as a capital gain or loss. Here's where this gets really painful. An investor can earn $50,000 in staking rewards during a bull market when crypto prices are high. Then crypto crashes. Their $50,000 in rewards is now worth $10,000, but they still owe taxes on the $50,000 they received. Their tax bill could be about $15,000, but their crypto is only worth $10,000. They literally owe more in taxes than their crypto is worth. This is why you need to set aside money for taxes when you earn staking rewards, not when you sell them. That brings us to point number 4. Using crypto to buy things, also taxable. Using crypto to purchase goods or services is a taxable event. You bought Bitcoin at $20,000. It's now worth $40,000. You use it to buy a $40,000 car. In the eyes of the IRS, you sold Bitcoin for $40,000, realizing a $20,000 gain, and used the cash to buy the car. That $20,000 gain is taxable, even though you never converted it to dollars. This applies to everything: buying a coffee with Bitcoin, purchasing an NFT with Ethereum, paying for services with crypto, and even tipping someone in crypto. Every time you use crypto to buy something, you're triggering a taxable event. For example, an investor might buy $5,000 worth of Bitcoin early on. Later, they use it to buy a $50,000 car when Bitcoin has appreciated significantly. They think they're being smart, avoiding capital gains by never selling to dollars. But they actually trigger a $45,000 capital gain when they buy the car. Their tax bill could be over $10,000, and they have no cash to pay it because they spent all their Bitcoin on the car. They end up taking out a loan to pay their tax bill. That seems backwards. Point number 5, airdrops, forks, and free crypto. Here's the secret: they're not actually free. Free crypto is taxed. Airdrops. If you receive crypto through an airdrop, it's taxable as ordinary income when you receive it, based on its fair market value. If you received 100 tokens worth $10 each, you have $1,000 of ordinary income. Hard forks. If you owned Bitcoin when Bitcoin Cash forked, you received free Bitcoin Cash. That's taxable as ordinary income when you gain the ability to transfer or sell it. Mining. If you mine crypto, every coin you mine is taxable as ordinary income when you receive it. Referral bonuses. If you get $50 in Bitcoin for referring a friend to an exchange, that's $50 of ordinary income. Almost every way you can receive crypto is taxable as income when you receive it. For example, an investor could receive $20,000 worth of tokens in an airdrop during a bull market. They don't sell it, just hold them. Then the tokens crash and become worthless, but they still owe taxes on the $20,000 income from when they received it. Their tax bill could be about $6,000 for tokens that are now worth nothing. This is why you need to plan for taxes when you receive crypto, not just when you sell it. Point number 6, what's not taxable? There's very few exceptions. Let's be clear about what's not taxable. Buying crypto with fiat. So purchasing Bitcoin with dollars is not taxable. You're just converting cash to property. Transferring between your own wallets. Moving crypto from Coinbase to your hardware wallet is not taxable. You still own it, you're just moving it. Holding crypto. Simply holding crypto and watching its value change is not taxable. You only owe taxes when you dispose of it. Gifting crypto under 2024 limits. You can gift up to $18,000 per person per year without a tax consequence. Donating crypto to charity. If you donate appreciated crypto to a qualified charity, you can deduct the fair market value and avoid capital gains tax. This is one of the most tax efficient things you can do with crypto. But these are the exceptions, not the rule. Almost everything else you do with crypto is taxable. Crypto taxation is complex, but ignorance isn't a defense. The IRS is getting better at tracking crypto every year. Exchanges are required to report your activity. And when the IRS catches up to you, you'll owe back taxes, penalties, and interest. This video showed you what's taxable and what's not, the before and the after. The bridge to getting compliant and staying compliant is where Numeratus comes in. If you want to stay on top of crypto tax regulations as they change, join the Numeratus community at numeratus.org for $100 a month. Yes, that $100 a month is a write-off. We break down new IRS guidance, discuss compliance strategies, and keep you informed. If you need a more hands-on approach, if you have unreported crypto income, complex transactions, or you just want professional guidance handling your crypto taxes, book a consultation at numeratus.us. We'll figure out exactly what you need. We specialize in crypto tax compliance. That sounds interesting to you? Let's get into it.